Hi, everyone. My guest today is Dave Cole from EMX Royalty. I have a ton of respect for him, and I like EMX Royalty. It is one of my favorite companies. I am also a shareholder, and you will hear in a minute why. So I hope this interview will be full of information and will be very useful to all of you. So Dave, welcome to the spotlight.
Yeah, Peter, thank you very much. Happy to be here. Happy to talk to you.
I'm delighted that you are here. So normally I should start with the team, but I would like to ask you, how did you start this company?
Well, I'm happy to answer that question. It's a very interesting question. So, I've really only had two jobs, quote unquote, my entire life. I worked with Newmont Mining Corporation for 18 and a half years and left to start this company. And that was about 21 years ago. That sums up my whole career. But while I was at Newmont, from an educational perspective, I have a bachelor's degree in geology and a master's degree in economic geology, which is the study of the geology and beneficiation of economic mineral deposits, as I'm sure you are aware.
Mm-hmm.
And I worked during that time. I worked with Newmont. I worked, mine sites, underground, open pits, exploration, near mine exploration in greenfield environments all over the world, and really had a great time. My super passion was really more at the greenfield side and the exploratory side. And while I was at Newmont, I witnessed a few key events that shaped my view of the business. One would be a gentleman by the name of Lyle Campbell, who was a private prospect generator in Nevada, and he was a copious owner of mining claims in Nevada. And he would acquire these mining rights, mining claims. He would add value by collecting and making observations in the field, and then selling those on and keeping royalties and other property payments associated with those transactions. And he did very well. And his royalty portfolio, by the time he passed, when he was nearly 90, was worth a tidy sum of money that he put together on his own. And I always thought that was a great business model, because he's leveraging his talents at prospecting and unearthing prospectivity and control of mineral rights, but not doing what he could not afford to do, and that's build mines and drill off large deposits, etc. And so it's a very synergistic model. And he was really conducting what we today call royalty generation, which is prospect generation focused on the royalty component, which is one of the key reasons why I believe you like the company. But so I observed Lyle Campbell. And then another observation I made was a tall, thin gentleman by the name of Pierre Lasson that would come out to the mine site, because when I was working at Gold Quarry on the Carlin Trend in northern Nevada, and he would come out and he always had a smile on his face, and they were collecting royalty checks. And I said, you know what? That's a pretty good business, because the vice presidents at Newmont were stressed out, commonly overweight, not really enjoying, not smiles on their faces. And here is Pierre Lasson, smile on his face, mailbox money, checks coming into the mailbox. And I thought, I'd rather be Pierre Lasson than the vice president at Newmont. So with those combined with some other observations that I made, came to the realization that, I wanted to form a prospect generation company, and I wanted to build a portfolio of royalties. And so I left Newmont after 18 and a half years, and Newmont was financially supportive and is still today a shareholder. And I'm just delighted to have their support. And we have a lot of friends at Newmont, and a number of us here at the company are former Newmont employees as well. So that's it in a nutshell.
Okay, thank you. I like the royalty model because if the gold price goes up, then your cost base does not change. And it gives tremendous leverage to the gold price, for example, to the gold price. And you don't have to spend money on exploring, developing, just have to wait and sit and grow. And there is the optionality as added bonus, and you are also well diversified. Generally, the royalty companies are. And you have not one, but three. Sorry? Yeah, thank you. You have not one, but three business models. Could you please expand on that?
Yeah, I'm happy to. So, going back to the Pierre Lasson model, right, where he purchased a royalty out of the Reno paper for $1.7 million. And thanks to this aspect that we call optionality, which can go with you or against you. But in this case, it went with him. That royalty that he bought for 1.6 or $1.7 million out of the paper has now paid right at $1 billion cumulatively over its life and is still paying. And these aspects of optionality are very interesting. You touched upon commodity price optionality. So when Pierre Lassonde bought that royalty, the price of gold would have been $300 or $400 an ounce. I think it was 300 and change. And today, of course, it's 2,500. But more important than commodity price optionality, which we all should have exposure to, is discovery optionality. When they find a whole nother ore deposit on your ground at no risk and expense to the royalty holder massively benefits. When they develop new mine engineering techniques and figure out how to mine more efficiently, buy bigger equipment, or figure out how to have better rock stability underground, thus enhancing their ability to recover more gold underground. And when the metallurgists figure out how to refine their metallurgical techniques to be able to recover more of the gold that's in the rock, all of those things are to the royalty holder's benefit. And here's the interesting aspect of that: they are multiplicative. So the price of gold goes up, the metallurgists figure out how to get more gold out of the rock, the engineers how to figure out how to mine more rock, and the geologists double the size of the resource. The royalty holder wins massively. And it is that multiplicative aspects of optionality is why you want to own royalties and portfolios of royalties.
Yeah, if I, for example, in case of gold, short term, I could imagine a correction, but in 3 years, 5 years time, I see much higher gold price. So yeah, this is how you create value. And if you get $1 million income, what is your margin?
So that depends upon your definition of margin. So,
Okay.
you know, we have 5 consecutive quarters of positive cash flow. I'm more concerned about cash flow than I am about, and I'm concerned about economic earnings, not about IFRS, International Financial Reporting Standard earnings, because they're distorted by non-cash items that do not relate to reality, right? And so in managing the company, I'm focused on cash flow and how to allocate that, not on my margin as defined by the rules of accounting, which I believe, quite honestly, cause confusion in the market. And I can give you a great example. So Caserones, they're doing a great job there. Lundin's come in about 70%. They're putting lots of money into exploration. We are very, very, very bullish on that royalty footprint around Caserones. But because of accounting rules, we have to depreciate as that royalty pays to us based upon the purchase price, right? So we're depreciating the value of Caserones over time. And the same with other royalties that we hold. We're depreciating them over time, totally without any regards to what their innate actual value is. And so that translates, that accounting necessity translates to numbers that go in the books. It looks like you're losing money, right? And this causes confusion in the marketplace. And I'm sure you're perfectly well aware of this, and people that are financially fluent understand that. But it does. It's not uncommon for me to get questions around that.
Yeah, you are right. I am sorry. I apologize. Later, I wanted to ask about your accounting method, but that means that a given royalty is not now in your book, but you can, as the income is coming in year by year, then you can subscribe you can get rid of the cost also, so you can decrease your tax payment also.
That's correct. It's absolutely the depreciation is the word you're looking for, and that depreciation does enable us to pay less tax. 100% correct.
Yes. And that's an advantage.
Yep. And then, you know, you were touching upon a subject which I commonly educate people on, and that is the concept of whether or not you acquire an asset and book that value, or you expense it. And so all of the work that we do in royalty generation, or nearly all of our expenditures on the royalty generation side, are expensed each quarter. So those go through as expenses, and those create losses on the books that we can offset against gains, so it's tax efficient. It's also very transparent to the investor. They can see how much money we're spending on royalty generation. My competitors who do not do royalty generation, they just buy royalties, which we do also, as you pointed out a minute ago. We do the same thing that they do when we buy a royalty. We capitalize that expenditure. And so it goes on the books. It has book value. That does not show up as an expense right away. That gets depreciated after that asset goes into production. Usually when they're not in production yet, they'll sit there at that same book value, roughly that same book value over time. So, but going back to the generative side where we expense the expenditures, because most of my competitors do not do royalty generation, or they do it in a very small way as compared to how we build our portfolio.
Yes.
They show less expenses on a quarterly basis and have a lower expense ratio that some people will talk about. Well, that's because they're capitalizing their expenditures. Hypothetically, I could generate a portfolio of a dozen royalties quite inexpensively through royalty generation. And a dozen royalties of similar quality could be purchased by one of my competitors for a multiple of what it cost me to do that. They would capitalize that because it was a royalty purchase and would not show up as an expense. I'm expensing it. And people say, Dave, why are you spending so much money? And the answer is, why I'm spending so much money? Because I'm building the portfolio. Yeah. Those are assets going into our pyramid.
Thank you. Thank you for correcting me.
Yeah.
Great,
No,
great. Thank you.
I'm constantly explaining this particular aspect of our business to people because we have a slightly different business model that necessitates a different accounting methodology.
Yeah. Great. And what I also like is that usually when your competitors buy an asset, it will be in production in 10 years, just to say a number, and they don't have an income for 10 years, but you do for at least some of the assets because you have pre-production payments, right?
So, good point.
How is that?
We have over 250 mineral property positions, or roughly 170 royalties worldwide, and there's quite a bit of pre-production payments that we have built into our deals. And this is something I learned from Lyle Campbell, going back to the earlier story about Lyle Campbell. Lyle Campbell was very good about building in annual minimum royalty payments, affecting efforts while be built. And one of the Achilles heels of the mining industry is a long time lag that goes from prospecting to production, right? So these pre-production payments are a great way to compensate for that. So our early stage portfolio has a lot of pre-production payments that varies year to year. We have a couple of large ones coming up here next year, I think accumulating to roughly $10 million from just 2 payments. But we get share payments, lease payments, some as small as $10,000 and others are millions. And that's a key part of our model. But in addition to that, we have strong cash flowing production royalties at the top of the pyramid. And this is the thing that really separates EMX, is that strong cash flow at the top of the pyramid and the strength of a couple of those royalties, namely Timok and Caserones and Leeville.
Yeah, that would be my next question. If you could tell me about your key royalties.
Sure. So I love to talk about all of them, but we'll hit Timok first. So we were the Timok magmatic complex is a geological terrain in eastern Serbia. That's Europe's largest historic copper and gold producing region, and it's the site of a major discovery called Brestovac. Many people just call it Timok, but the actual mine name is Brestovac. And that discovery, as luck would have it, was just off of a royalty that we generated, just off the boundary of a royalty that we generated, literally a couple hundred meters away. And we had our ear to the railroad track. We realized what was going on there. We understood the geology. And so I knew that there was a small royalty on that license adjacent to ours that we generated. And I went out and I bought that royalty before it was truly recognized to be a world-class discovery. It turned into the largest copper gold deposit ever found in the history of Europe. And I bought that for 200,000 Canadian dollars. That's already paid close to 10 million and will pay for many decades into the future. It's a truly world-class asset that is now being advanced by Zijin. And that speaks volumes to the integration of royalty generation and royalty purchase. Because we have smart geologists around the world, business savvy, primarily executing royalty generation. But whilst they're doing that, they identify royalties on prospective mineral rights that are for sale or could be for sale that are not going through a sales process and being represented by Scotiabank. I can tell you straight up that one of the challenges of the whole royalty sector is the fact that it's no secret that royalties are phenomenal financial instruments. So when they go through a sales process, they tend to trade at robust valuations, right? And so it's really good to be able to try and find assets that are not going through a sales process, so you can pick them off or buy them before the data is fully understood as to the potential of the property, which is what we did here. And you know, if I could emulate that once every couple of years, I would really be famous. But you know, even just to pull that one off once in my career is a phenomenal thing to have accomplished. So that's a world-class asset, cash flowing nicely, and we think the world of Zijin. We believe they're doing a bang-up job. They are getting metal out of the ground. And last quarter, that paid $1.586 million for what nominally sounds like a small royalty, 0.3625%. That will expand by multiples when they get into the lower porphyry zone, where they intend to put in place a block cave. And so we're really excited about the long-term potential. That's a kingpin asset. But going on to the next one, also a copper porphyry. And the one in Serbia, Timok, is copper gold. The one in Chile, Caserones, now operated by Lundin Mining Corporation, is copper and molybdenum. We're delighted to be exposed to copper. And we think it's the most strategic element on the periodic table from an economic standpoint. And we think we're just absolutely delighted to be exposed long-term to long-lived copper assets. And Caserones is another great one. Our effective royalty right there, having purchased multiple tranches of that royalty, is now 0.8306%. And, you know, we're looking at post-tax payments, you know, getting close to $2 million a quarter. And these are really nice numbers coming into us. And I believe that Lundin is pumping a lot of money into exploration, and our royalty footprint goes well beyond the Caserones mine itself. It's a quite large footprint. And Lundin has outlined 10 or 11 high priority targets within that footprint and pumping in. They announced this year $15 million USD in their exploration program. So we're just delighted. So, you know, that's why you want to own royalties. Strong cash flow from the operating mine and lots of exploration going on, adding to the resource. That's the recipe for success with a royalty.
Yeah, and I recommend to everyone to download your presentation, the actual presentation. The viewers can find more information about other royalties. Okay, so let's go further. Thank you. And you told me that you have a triple-digit number of assets.
Correct.
Am I correct that you have something like about 40 pre-production paying assets?
That sounds about right. Yeah, it's in that neighborhood. Yeah, I don't know the exact number, but that sounds about right.
And 6 producing assets. So
correct.
The future is bright, I would say. And for the beginners, what is the difference between mineral right holder versus royalty?
Yeah, so let's do mineral rights first. Yeah. And how you acquire mineral rights varies depending upon the country that you're working in the United States and in Canada. Much of the land, not all, has public mineral rights. So it's owned by the government, and you can have the right to explore and work on those mineral rights and control those mineral rights by staking mining claims. And the mining law in the United States that's still in the books today was written in 1872. And that requires us to go out and literally put a piece of wood in the ground and write a notice. And then we can stake that unpatented mining claim and control those mineral rights. If you're working in Sweden, it works differently, but still very efficiently, perhaps more efficiently. That is that you can file online and stake or apply for mining licenses. And so exploration licenses initially that become mining licenses with time and work. And so those exploration licenses can be acquired from the government. And that's the way many of the countries around the world do that. They have various types of mining laws, but they enable you to acquire mineral rights through license application via the government. And then another way is for private mineral rights. There are a lot of private mineral rights in the United States as well, and some private mineral rights in other countries, in which case then you would have to negotiate with the private owner of those mineral rights to get control of or gain access to those mineral rights. So that's kind of a rough answer to how you control mineral rights. And what mineral rights are is there's the subsurface rights, you know. So if you're in the oil business, it would be the oil that you're after, or the natural gas.
Yeah,
in our case, you know, we're commonly prospecting for copper, gold, and related metal deposits within geological terrains that are conducive for those. And you control those mineral rights, and you would have, subject to permitting, the ability to advance those, right?
Yeah.
Now, a royalty is in the mining business, is very similar to a royalty in the book business. Let's say that you, Peter, write a nice book, and you sell the rights to that book to a publisher, and the publisher sells that book all around the world, and you keep a royalty, a cut off the top of which the publisher gets. So the publisher's selling books to bookstores, and you say, I get a 2% royalty. And so 2% of a slice off the top of the gross revenue to the publisher would come back to you. Same idea in the mining business. So, you know, commonly when we sell that 2% royalty runs with the land in the United States. In other countries, it has to be a contractual arrangement. And that is usually perpetual, not always, but commonly a perpetual obligation on behalf of whoever owns that mining claim and produces metal from that mining claim to pay us 2% of the gross proceeds. And usually those are called net smelter return royalties, NSRs. And that is the gross payment to the mining company after the smelter deducts their fees. There's some other smaller deductions, but I'm just trying to keep it simple. So those are NSR royalties. They're the most common type of royalty. There are other types of royalties. There's net proceeds royalties, net profit royalties, et cetera, but most royalties and most of the royalties we control are NSR royalties, net smelter return royalties. And they're really a cut off the gross revenue to the mining company from production.
Okay.
Did I explain that right? Did you?
Yeah. It was more than enough, I would say.
Okay, I'm sorry. Yeah,
I visited New Zealand earlier this year, and there you can also claim specific land, and then only you have the right to mine gold from that, for example. Yeah. And so
New Zealand has some great geology, by the way.
Yeah. Yes. Maybe I phrase my next question differently. So do you target a specific a revenue breakdown by metal? For example, 50% gold, 40% copper income, or when you claim a right or you purchase a royalty, it really doesn't matter if it's gold or copper, but it should be the right kind of mineralization.
So I get asked this question a lot, Peter, and my answer remains the same. We're interested in discovery optionality.
Okay.
So we're most interested in acquiring royalties on very prospective mineral rights. Mm-hmm. Mineral rights that our geological intelligence tells us have the potential to win big. And we love copper, we love gold. We think it's fine to be exposed to molybdenum, lead, zinc, silver, copper, cobalt, nickel. And so we're exposed across the metal space. And we've never said, oh, we want to have 40% of our income from copper. That's just not the way we've approached this. We've approached this from the manner that we want to allocate capital astutely and be exposed to prospective mineral rights. I'm fundamentally of the opinion that everybody should be exposed to as many mineral rights as they can, because the value of mineral rights long-term is only going up. And the best way to be exposed to mineral rights is through royalty ownership. So what drives us in this analysis, or this question that you're specifically asking, is prospectivity, not commodity, not the specific commodity.
And am I right that it has also two advantages, this strategy, that the available land is less and less, and the other one is that the more you can define what is on this land, what you can find there, and how many of that product, the higher the cost is, the less risk. So if you can purchase it earlier, it costs you less.
Yeah. I mean, we could stake a mining claim in Nevada on open ground for a couple $100.
Yeah.
Yeah. Yep. Yep.
That doesn't seem
Yep.
too
You can
much.
acquire a fairly large exploration license in Sweden for a few thousands of dollars, right? And but of course you have obligations going forward, right?
Yeah, of
Yeah.
course. Yeah.
Mm-hmm.
Great. And you answered the next question. Do you have also nickel exposure? You do.
Yes.
I also like nickel. And what is your goal? What is your vision if you look forward 5 years, 10 years, 15 years?
Yeah. I get asked that question a lot, and my answer is actually fairly simple. My goal, and I view my responsibility, is the long-term, significant, market outperforming compounded annual growth rate of our share value. That's it. That's my job, right? And we want a solid CAGR. My CAGR right now is less than I want it to be, and we first brought in money from outside sources, not including seed stock, at 15 cents USD per share, split adjusted, and till today, that's roughly a 14% compounded annual growth rate, which is substantially better.
It's not bad.
Than that's substantially better than the S&P 500, but it's not where I want to be. And I want to be in the upper teens, 17, 18%, which is the number that Franco-Nevada achieved pre merger into Newmont Mining Corporation when Newmont bought Franco in Normandy many years ago. And their compounded annual growth rate since they left Newmont is also in that mid to high teens. And that's because the business model works. And it's interesting, if you look at Royal Gold's long-term CAGR, it's going to be a similar number. And royalties are just great things to own. I've always been fascinated by the fact that Royal Gold approached the world more from an engineering standpoint, and Franco-Nevada approached it more from a being exposed to prospective mineral rights and discovery optionality standpoint, and they're both hugely successful.
Yeah.
And even though they have slightly different cultures and different approaches, they're both successful. And what's the common denominator? They own royalties. That's the common denominator. And so, what's my long-term goal? Strong CAGR. Long-term CAGR, not the CAGR by next weekend, but long-term CAGR. Compounded annual growth rate.
Yeah. Thank you. It is not financial advice, of course, but one should not buy this stock for 3 months, half year, 1 year. We should give you time to work. 5 years, 10 years at least.
I believe we have a buy and hold business model. That's my personal opinion. Yeah.
Okay. What did you do in the last 1 year to achieve this goal?
Yeah. So, Peter, as we've discussed, we do a great job of building that long-term discovery optionality at the base of the pyramid fairly inexpensively. But we also aim to occasionally buy assets to put at the top of that pyramid to really add scale to the business and increase our cash flow. And we've done a great job in syndicating the purchase of Caserones with Franco-Nevada, as well as purchasing different tranches of the Caserones royalty, which has really helped us. And that is now our largest cash flowing royalty on an annualized dollar basis. And we're just delighted to have accomplished that over the course of the last couple of years, right? That was a key step for us. And some of the monies to buy that royalty came from a large strategic investment win that we had in Russia, of all places. We exited Russia in October of 2018 very profitably. And some of those monies, a good portion of those monies, went into the purchase of this Caserones royalty and the portfolio that we bought from SSR, which is also performing very nicely. And then in addition to the monies that we got from the sale of Malmish in Russia, we also borrowed money from Sprott, and now that has been refinanced with Franco-Nevada. And those monies were also utilized to gain scale in the business. And so I'm happy to have a little bit, or I'm not concerned to have a little bit of leverage, some debt on the books. Right now it's at 35 million USD. And that money was well invested to gain cash flowing assets such as the SSR portfolio and the Caserones royalty. I believe it was a smart thing to do.
Thank you. And I wanted to ask more about the Franco-Nevada relationship. Why did they join you? Can you explain us what do you do together?
So Paul Brink has been asked this question before. I've heard his answer, and I've asked him if I could repeat that to you, and he said I may. And that is that they're specifically interested in our royalty generation business.
Mhm.
They know that that's a part of our business that does not compete with them. And they believe it's an astute thing to do, but are not in a position to do it themselves.
Mhm.
And they've always been intrigued by the royalty generation work. They've been friends of mine and supporters of ours morally for a long time. And then I was able to get them in the door and become shareholders in EMX. We're the only junior royalty company that they own stock in. And now they hold our debt, and that's a 5-year note with, we can pay it down or not. It's up to us. And we really appreciate that. And we appreciate the fact that they have the confidence in us to take on that $35 million debt and refinance that. And it's less onerous to work with Franco than it is to work with, a bank that needs, paperwork continually. And so we're delighted to have that relationship. And then furthermore, we have a joint venture with Franco to look for early stage royalty financing opportunities. And we're always cranking through different opportunities, looking for the one to take to Franco.
Mm-hmm. Good, great to hear. And if I look into the future, near-term future, what are your plans forward? What may you tell me?
So more of the same. Yep. So we want to allocate capital astutely. We're driven by prospective geology. We will continue to exercise our 3 business approaches: the strategic investments, which over the course of the history of the company have netted us $55 million USD. That's a nice wind in our sails that enables us to gain scale in the business. Generate royalties, which is our bread and butter. We're very good at that. And then patiently wait and look for opportunities to pick off buying royalties. And given the fact that we're currently trading at a fraction of our NAV, that we will not issue huge amounts of shares to buy assets, right?
Thank you. That was my next question. That
sure, I knew that one was coming. I knew that question.
Yeah, I know you are proud of that. That you don't dilute the shares, but you don't have this plan to do that. So I'm happy. And you talked about the value proposition. You mentioned the fraction of the NAV value. You also have a stock buyback program because of that.
Yes, exactly.
So why is this company undervalued?
So the entire sector, ironically, it's the first time in my career where we have record gold prices or near record gold prices, strong copper prices, strong silver prices going through the periodic table. And the capital markets in the mining and natural resource space are really struggling. And so a lot of that is really a beta effect. If you look at our alpha performance relative to the other smallish royalty companies, we're doing quite well. We're either trading in parallel or slightly better than some of my competitors. Long term, it's alpha performance that I can effect. We're always striving to do that. But this beta event where gold companies and royalty companies are struggling despite high metal prices is an interesting phenomenon. Somebody smarter than me can explain to you why that is happening.
That could be. I talked with Aditya Patanaik during the conference in Boca Raton, and he told me that in the last few years, now this year the gold price, of course, increased substantially, but the previous few years it stayed flat, while the companies had inflation as well. So the costs were rising, and now the gold price is skyrocketing almost, but it didn't. The valuations did not catch up yet. We hope they will. Okay. Can you mention a few specific royalty values, if you may tell me what is the value there, the huge value that is not recognized by the market?
Yep. So of course, because of exchange rules, I'm not supposed to tell you what our internal NAV calculations are, but you can go to the HC Wainwright, who's the only bank that covers us currently. I am of the opinion that one or more major banks will initiate coverage on us in the near future. So please, let's all watch for that. I hope that is the case at least. The And you can go and see H.C. Wainwright's numbers. I'll let you and your listeners go and find that. And you can see that, H.C. Wainwright has a robust NAV on us. And we clearly believe that we're trading at a fraction of NAV. And that's why we are doing a share repurchase program. I cannot go out and buy royalties of the quality of Timok or Caserones at below NAV. They'll trade at a full valuation. But I can buy my own shares back at a fraction of NAV. That's a good thing to do with our capital.
Thank you. And I also encourage the listeners or the viewers to visit these kind of conferences, for example, the Rule Symposium, because then you get more insight into the net asset value numbers. Okay.
I really like that Rick Rule Symposium, and I also like the online classrooms that he does. I believe he's doing a great job of educating people, and the more educated the investors are, it betters the entire business.
Yeah, I agree with you, and also just a question occurred to me that how do you use the cycles to your advantages?
Yeah. So, and that reminds me of another Rick Ruleism, right? Rick Rule says, be a contrarian or be a victim. Yeah. That's one of the things that he says. The other thing that he says is use the cycles to your advantage rather than be used by the cycles. Yeah. And sometimes it's easier to say that than to actually execute on that. But I'll tell you that the way we view that, we always try to be counter-cyclical to the extent that we can. You can't always predict these things fully. But when we see other people not allocating capital, we like to. Yeah. And when everybody's allocating capital, we like to be more patient. Yeah. Yeah. And there's multiple ways that we can actuate that. One would be, there was a period of time when nickel prices were low, and we were going around inquiring mafic and ultramafic rock dominant systems. So that's where you find sulfide nickel and related copper, platinum group elements, and cobalt. They tend to be in that environment with these, what we call mafic rocks. It's a geology term. And so we try to gain exposure to those when it was out of favor. And there's been periods of low gold prices where we, went nuts at acquiring gold assets. And so that's one way to play that game. The other way is that when you have robust share valuations and your cost of capital is reduced, then you can utilize your shares to make portfolio acquisitions, as we did with SSR as a recent example. So there's multiple ways where you can play that. I wish that the cycles were not so deep and exacerbated in this sector. It would make my job a lot easier, but that's just not the way it is. We have to live with it. And so I get a lot of phone calls asking more or less what you said. Why is your share price down? It's like, because the market's down. I'm sorry, and it's like, well, what are you going to do about it? I'm saying, well, I'm just going to execute good business and allocate capital astutely. And I know someday it's going to go the other direction. It's when, not if.
Yeah. And you buy what is hated. And now we are not in the deepest point of the cycle, I think. But your share price is still down. So yeah,
that's a fact.
It makes sense. And thank you for
not diluting. It's also an opportunity. It's also an opportunity. It's a fact. It's also an opportunity, right?
Yes. Yes, thank you. And thank you for not diluting now. Okay. So would you like to add anything else if I ask what do I get if I pay the market cap today, something like 190 million?
Yeah, that sounds right. Yep. So,
or you cannot say anything.
250 mineral property positions worldwide, strong cash flow, distinctly positive cash flow for 5 quarters in a row. That's not going to change. Very long-lived assets in that portfolio, including Caserones, Timok, and Leeville, as a nice gold royalty that we've had for years. And the team that has built this portfolio is firing on all cylinders, and we just continue to do good business. There's always things in the portfolio I'm particularly excited about. One I'll point out, as discovery optionality in action, is the continued advancement of Diablios, where we have a royalty that we got very inexpensively, and that's turned into a real gem. I don't know when that will go into production, but it's turning into a nice fat silver gold system. And then the Park Salyer discovery that we have a royalty on, and that triggered a $3 million payment to us as an example of one of our pre-production payments. That's a nice win coming out of discovery in the portfolio. Deep portfolio discovery optionality, we call these. And then there's another one. That is the Peak discovery, P-E-A-K-E, being advanced by South 32, which is the extension of the big, huge Taylor lead zinc silver deposit that zones laterally into a copper zinc silver deposit. And some of the drill holes of South 32 is put into that new discovery on our ground are salient. Nice fat intercepts. I don't know when that will go into production, but that's metal in the ground that I have a 2% royalty on perpetually that cannot be bought out. And that's a key value within the portfolio. Not cash flowing today, but it's an example of why we are in the business.
Yeah, probably it will. Okay. And wonderful news, but what could go wrong?
So commodity prices will always ebb and flow. And the, price of gold's had a big run. Maybe it'll go down. I don't know. Yeah, if it does, it'll have an effect. If there's global economic slowdown, the price of copper retreats. That's also a possibility. I would use those as buying opportunities personally, but we're always exposed to that risk. And then another type of risk would be geopolitical risk. Always something could go wrong in a country. Mine engineering risk, you could have a pit slope stability failure at a mine that slows production. We recently had a strike at Caserones that caused a sell-off on our stock. The strike was settled in a couple of weeks, so it really doesn't have any effect. But those are all things that can happen.
Okay. We understand. And could you tell me a few things I did not ask, because you know more about the company than I do?
Well, you've asked a lot of coherent questions, Peter, and people often talk to me about the interplay between royalty generation and royalty purchase. Mm-hmm. And are we going to augment our royalty generation program as the top line revenues and money coming in the door to EMX increases? And my philosophy on this is that I like my royalty generation business on an inflation adjusted basis to remain fairly constant going forward and should feel lean and mean. That's when the best value is created, when the guys feel that they wish they had a little more money. And that continues whilst our overall business is growing. So the percent of the overall business that's royalty generation is incrementally decreasing through that organic growth of the revenues, right? Which means that we have more and more arrows in the quiver to hunt bigger game with. Yes. So just from the positive cash flow, we don't have to issue shares to do a deal. From our existing positive cash flow, we can buy incremental royalties to augment that portfolio, in addition to funding the ongoing royalty generation.
Yeah. Great. Thank you very much. I think our time is up. And ladies and gentlemen, this is how a CEO should answer questions with power, honesty, clear answers. Thank you very much. It was very nice.
That's a nice compliment, Peter. Thank you.
Yeah, I think I am delighted that you are here. Thank you very much. And yeah, I think we can wrap up. I will put some links and information into the show notes. Should I include something else? Your website.
If you wanted to go, our website, emxroyalty.com. Absolutely. Yeah. And there's contact information with respect to reaching out to us and asking our corporate communication people questions about the company. Happy to answer those and provide all the publicly available data that we can.
Okay, thank you very much. Also, as a shareholder, thank you. Keep up the good work. Thank you.
Let's do it. Yeah, thank you.